Breaking news for every senior, retiree, and Social Security recipient watching right now. If you are collecting Social Security SSI or SSDI, or if you are approaching retirement age, there is a new IRS rule that could directly affect how much money you keep in your pocket this year. And the disturbing truth, most seniors have absolutely no idea this rule even exists. We are not talking about a small technicality buried in fine print. We are talking about a change that could impact your taxes, your benefits, and your financial security in a very real and very personal way. Here's what makes this even more alarming. The people who are most affected by this rule are the ones least likely to hear about it through mainstream news. The IRS is not sending everyone a personalized letter. Your local news probably hasn't covered it in a way that makes sense. And if you miss this, if you don't take action, it could cost you hundreds, maybe even thousands of dollars. This is not a scare tactic. This is the reality that millions of American seniors are facing right now, and most of them are completely unprepared. But you are watching this video, and that means today you are going to be one of the few who actually knows what is going on, what this rule means for you, and exactly what steps you need to take to protect yourself. Stay with me all the way to the end of this video, because by the time we are done, you will have complete clarity and real peace of mind. Welcome back to this channel, the place where seniors, retirees, and Social Security recipients come to stay informed, stay protected, and stay ahead of the changes that affect their lives and their income. If this is your first time here, I want you to know something important. This channel exists for you, not for politicians, not for the IRS, not for big financial institutions. For you, the everyday American who has worked hard, paid into the system, and deserves to understand clearly how that system works. We break down complicated government rules, IRS announcements, Social Security updates, and benefit changes, and we explain them in plain, simple English. No jargon, no confusion, no fluff, just the information you need, delivered in a way that actually makes sense. Every single week, millions of Americans miss out on money they are legally entitled to, simply because they did not get the right information in time. That is what we are here to prevent. So if you have not already, please take a moment right now and hit that subscribe button below this video and tap the bell icon so you get notified every time we post a new update. Your financial security literally depends on staying informed, and subscribing to this channel is one of the simplest and most powerful things you can do to protect yourself. Now, let's get into what this new IRS rule is, why it matters so deeply for seniors and Social Security recipients, and what you need to do about it right now. What is this new IRS rule? Let's start with the basics, and let's be very clear about what we are talking about. The IRS has quietly updated its rules and guidance around how Social Security benefits are taxed, specifically around what is known as combined income or provisional income. This is not a brand new concept, but the thresholds, the calculations, and how they interact with your other retirement income have shifted in ways that are catching millions of seniors completely off guard. Here is the core issue. When the original Social Security taxation rules were created back in 1983 and then expanded in 1993, the income thresholds for determining whether your Social Security benefits are taxable were set at specific dollar amounts. The threshold for a single filer was set at $25,000 in combined income. For married couples filing jointly, it was $32,000. Here is the problem, and it is a big one. Those thresholds have never been adjusted for inflation. Think about that for a moment. The cost of groceries has gone up, rent has gone up, medical expenses have gone up, gas has gone up. Everything costs more today than it did in 1983 or 1993. But the income limits that determine whether your Social Security gets taxed, they have stayed exactly the same for decades. That means more and more seniors, people who are not wealthy by any definition, are now crossing those thresholds every year. And when you cross those thresholds, up to 85% of your Social Security benefits can become subject to federal income tax. Let that sink in. Up to 85 cents of every dollar you receive from Social Security could potentially be taxed. What changed recently? Now, here is where the new IRS rule update comes in. and why this is so urgent right now. The IRS recently issued updated guidance and clarifications that affect how combined income is calculated, what counts toward that threshold, and how certain types of retirement income, including distributions from IRAs, pension payments, part-time work income, and even certain investment earnings, factor into the equation. Specifically, the IRS has clarified that the following types of income count toward your combined income calculation: your adjusted gross income. This includes wages, self-employment income, and distributions from traditional IRAs and 401k accounts. Tax-exempt interest, yes, even interest from municipal bonds, which many people believe is completely tax-free, counts toward this calculation. And half of your Social Security benefits themselves. What this means in practice is that many seniors who thought they were safely under the threshold are now finding out, sometimes only when they file their taxes, that they owe more than they expected. And with the updated IRS guidance, there is less wiggle room than there used to be for certain deductions and exclusions that some tax preparers had been relying on. Let's make this real with an example. Let me give you a real-world scenario so this is not just abstract numbers. Meet Margaret. She is 71 years old. She lives alone in a modest home. She receives $1,500 a month in Social Security benefits. That's $18,000 a year. She also takes a small distribution of $12,000 a year from her traditional IRA to cover living expenses. And she has a small municipal bond that pays her $2,000 a year in interest. Here is how the IRS calculates her combined income. Her adjusted gross income includes the $12,000 IRA distribution. Add the $2,000 in tax-exempt interest. Add half of her Social Security, which is $9,000. That puts her combined income at $23,000. Now, the threshold for a single filer is $25,000. Margaret is just barely under. She is safe for now. But what if her IRA distribution goes up slightly? What if she gets a small cost of living adjustment on her Social Security? What if she picks up just a little part-time income? Suddenly, without Margaret doing anything dramatically different, she crosses that threshold. And once she crosses $25,000, up to 50% of her Social Security becomes taxable. If she crosses $34,000, up to 85% becomes taxable. That could mean an unexpected tax bill of $1,000, $2,000 or more, money she was absolutely counting on to pay her bills. Now multiply Margaret's situation across the country. Tens of millions of seniors are in this exact position right now. They are right on the edge of these thresholds, and they do not even know it. And with the updated IRS guidance, the consequences of crossing those lines are more significant than ever. Why most seniors haven't heard about this? You might be wondering, if this is such a big deal, why haven't you heard about it before? There are a few reasons. First, the IRS does not do a lot of consumer outreach. They issue guidance documents and technical notices that are written for tax professionals, not for everyday people. If you are not a CPA or a tax attorney, you are probably not reading IRS technical bulletins. Second, the mainstream media tends to cover these stories only briefly, and usually in a way that is so general, it does not help individual people understand what to actually do. Third, and this is important, many seniors rely on the same tax preparer or the same simple tax software they have used for years. And unless that preparer or that software is specifically up to date on the latest IRS guidance, it is possible that these changes are not being accounted for correctly in your filing. That is a scary thought, but it is the reality. And that is exactly why this channel exists, to bridge that gap and make sure you have the information you need in language you can actually understand. Now let's talk about what you should actually do, because information without action does not help you. So let me give you some clear, practical steps. Know your numbers before tax season hits. Do not wait until April to find out where you stand. Right now, today, I want you to sit down and add up your expected income for the year. Include everything: your Social Security income, any IRA or 401k distributions, pension payments, part-time work, investment income, and yes, even tax-exempt interest from bonds or municipal funds. Calculate half of your expected Social Security and add it to the rest. That gives you a rough estimate of your combined income. If you are a single filer and that number is approaching $25,000 or $32,000 for married couples, you need to pay close attention. You may be closer to the taxable threshold than you realize. Talk to a tax professional who specializes in senior finances. This is not the time to wing it. If your financial situation has any complexity at all, multiple income sources, retirement account distributions, investment income, please talk to a tax professional. Ideally, someone who specifically works with retirees and seniors and who is fully up to date on IRS guidance. Ask them directly, given the updated IRS rules, how will my Social Security benefits be taxed this year? And what can I legally do to minimize that tax burden? A good tax professional will run through your numbers and help you understand exactly where you stand. And they may be able to suggest legal strategies, like timing your IRA distributions differently, adjusting your withholding, or using a qualified charitable distribution if you are over 70 and a half. That can help reduce how much of your Social Security gets counted as taxable. Consider adjusting your tax withholding now. Here is something a lot of seniors do not know. You can actually ask Social Security to withhold federal income taxes directly from your monthly payment. This is done using IRS Form W-4V. You can request that 7%, 10%, 12%, or 22% of your monthly Social Security payment be withheld and sent directly to the IRS on your behalf. This way, you are not blindsided by a large tax bill at the end of the year. If you think you may owe taxes on your benefits this year, adjusting your withholding now, proactively, is one of the smartest things you can do. It is much easier to manage small withholding amounts throughout the year than to come up with a large lump sum in April. Create a simple monthly budget that accounts for taxes. I know budgeting is not everyone's favorite topic, but here is the truth. If part of your Social Security income is going to be taxed, you need to know that before you make spending decisions. You need to budget based on your actual take-home amount, not your gross benefit. Write it down. How much do you receive each month? What are your essential expenses? Housing, food, utilities, medications. What is left over? And if taxes are going to reduce your net income, how does that change the picture? Having a clear monthly budget gives you control. It means you are never caught off guard, and it helps you make confident, informed decisions about your money. Do not ignore mail or notices from the IRS. If you receive any mail from the IRS, any notice, any letter, any form, do not ignore it. Do not set it aside for later. Open it immediately. Read it carefully. If you do not understand what it says, bring it to a tax professional or call the IRS helpline at 1-800-829-1040. There are also free tax assistance programs available specifically for seniors, including AARP's Tax Aid Program, which provides free tax preparation help to people 50 and older. You do not have to navigate this alone. Before I get to the final summary, I want to take just a moment to talk directly to you. I know how stressful it can be to hear about changes to your taxes, your benefits, or your income. I know that for many of you, Social Security is not just one piece of your financial picture, it is the foundation. It is what allows you to pay your bills, take care of your health, and live with dignity. And you deserve to have someone in your corner, someone who takes the time to explain these things clearly, honestly, and without trying to sell you something or scare you unnecessarily. That is what this channel is here for. Every week, we cover the updates that matter to you: Social Security payment schedules, COLA adjustments, SSI and SSDI changes, IRS rules affecting retirees, Medicare updates, and more. We cut through the noise and give you the information you actually need. If you have not already subscribed, please do that right now. Just tap the subscribe button below this video. It is completely free, and it could make a real difference in your financial life. When new information comes out that affects your income and your benefits, information that you need to know, we will make sure you see it. Also, if you found this video helpful, please share it. Share it with a spouse, a parent, a sibling, a friend. Anyone who receives Social Security or who is approaching retirement, because the more people who have access to this information, the better protected our community is. And drop a comment below this video. Tell me, did you know about this IRS rule? Have you already talked to a tax professional about how it might affect you? Your comments help us understand what topics matter most to this community, and they help other viewers feel less alone. You deserve clarity. You deserve to feel confident about your financial situation, and this channel is here to help make that happen. All right, let's bring it all together. Here is what we covered today, in plain and simple terms. The IRS has rules about how and when your Social Security benefits become taxable. Those rules are based on your combined income, which includes half of your Social Security, plus your other income sources like IRA distributions, pensions, and yes, even tax-exempt interest. The thresholds: $25,000 for single filers, $32,000 for married couples, have not changed in decades, which means more and more seniors are crossing them every year without even realizing it. The updated IRS guidance has clarified and in some cases tightened how these calculations work, which is why it is so important to review your situation now, not in April when it is too late to make adjustments. The good news? This is manageable. If you know your numbers, talk to a qualified tax professional, consider adjusting your withholding using Form W-4V, and create a clear monthly budget. You can navigate this confidently, you can protect your income, and you can avoid the kind of unwelcome tax surprise that too many seniors are walking into unprepared. You worked hard for these benefits. You earned them, and you deserve to keep as much of them as legally possible. Stay informed, stay protected, and we will see you in the next video.